Welcome to episode 4 of our educational series on 1031 exchanges. Be sure to watch our series on passive real estate investing basics and real estate taxation basics. We also encourage you to read our book, How to Retire from Being a Landlord, which you can order for free on our website or on Amazon.
In this module, we will cover the basic steps and timeline for completing a typical tax-deferred exchange under Section 1031 of the Internal Revenue Code. Although it's not a legal requirement, your first step before conducting a 1031 exchange is to build your deal team. At a minimum, you should be talking to your tax professional, a qualified listing broker, a real estate investment broker, and an exchange accommodator, also known as a qualified intermediary or QI.
In a 1031 exchange, the IRS requires a QI receive and disperse your exchange funds. If you receive proceeds from your sale directly, you automatically forfeit the ability to conduct a 1031 exchange. Of course, you can receive a fraction of your exchange funds, which we call boot. Any boot you receive in your transaction will be taxed. To learn more about boot, please watch episode 6. After you have an offer on the property you're selling, contact your QI to set up an exchange account. Your QI will ask you to sign an exchange agreement and will coordinate with your escrow agent to arrange for your sales proceeds to be paid directly to your QI on your behalf.
After your property sale closes and the net proceeds are transferred to your QI, you have 45 days to identify your replacement properties. Of course, the IRS limits the number of properties you can identify, and after the 45-day deadline, you can only purchase one or more of the properties that are included in your identification letter. Most taxpayers rely on one of two rules for identifying their potential replacement properties. The first is the 3-property rule, which is pretty straightforward. Under this rule, you can list 3 potential replacement properties, and you can buy 1, 2, or all of them. The other common option is the 200% rule. This allows you to nominate more than 3 properties, provided their total value is not more than double the value of your relinquished property. Jason, there's another far less common rule, the 95% rule, that we'll skip over.
Okay, then let's pause here to remind the audience that in a 1031 exchange, you're required to replace the entire value of the property you sold. If you sold a rental property for $1 million, subject to a $500,000 loan, you still have to buy at least $1 million worth of real estate to complete your exchange. You can either replace that $500,000 loan with cash or another loan, or you can invest in a passive replacement program with built-in financing so that you can replace your debt without having to apply for a new loan.
You can learn more about built-in financing in episode 6 of our series on passive real estate investing basics.
Now, after your 45-day identification deadline, you have an additional 135 days to close on your replacement property. At 1031 Capital Solutions, most of our clients acquire their properties before the 45-day deadline, and we never have to worry about the 180-day closing deadline. I should note that both the 45 and 180-day deadlines can be extended by executive order in the event of a disaster. Otherwise, there's no forgiveness and no extension from the IRS regarding these deadlines. Therefore, it may be a good idea for investors to start looking for their replacement properties while their relinquished properties are still in escrow.
If you follow these basic rules and deadlines, you can defer your taxes and reinvest your sales proceeds in a portfolio of replacement properties with the potential to change your lifestyle as a landlord. Thank you for watching. Please be sure to check out our other education modules and visit our website at 1031capitalsolutions.com.